Good day, everyone. We've got the tug of war that continues between central banks' easy money policies and negative news regarding the global economy. So far, the central banks seem to be winning this tug of war. The other day, we had some of the majors touch down on their 20-day moving averages. They've done that before a couple times. Such as on the NASDAQ, and each time it gets support. This was the third time for the NASDAQ, and sure enough, it made higher highs on volume. So that's all good and well in terms of following this trend. In terms of leading stocks, they still remain somewhat questionable. That's why we've been advising everyone to buy on weakness so that if you have to exit your position, maybe you're only selling it down a couple percent from where you bought it. Right now, we've got commodities, oil, and so forth that have been seem to have put in a significant bottom as they trend higher. I think helping the price of oil is the weakening dollar. There seems to be somewhat of a correlation there over the last few months, and also there's possible production cuts on the way. So that obviously bodes well for the price of oil, which is now trading well over $40 a barrel. It had been down as low as the mid-20s, and that was the low for oil. So looks like we're anyway trending higher for the time being. As far as the global markets, they're lagging as usual, but they are also putting in bounces of sorts, between the Chinese markets and the European bourses and whatnot. So at any rate, we should stay the course as this trend continues to unfold. And as you can see, the major averages are pretty much right now only a couple percent off their all-time highs. If you look at the S&P and the Dow, the NASDAQ's off a little bit more because it tends to be a little more volatile. That would be the NASDAQ composite. The NASDAQ 100 has shown a little more strength, and that's a few percent off its peak. So yeah, right now it's time to just stay the course. Not a whole lot more to say really about what's going on right now. So it's nice to have a little bit of a considered uptrend here, at least in the major averages after what they've been through starting last August. Yeah, the question of course remains, how long can this uptrend go? But it's the central banks. I think it'll come down to the central banks weighing in versus the degree and severity of the slowdown in the global economy. And there's evidence every now and then that things are not all well. The last couple of days, of course, were evident of that, with the IMF downgrading their projections on global growth. And yet the markets seem to hang tight and then move higher. So obviously that's telling us that despite the negative news, the money flow, the capital that's being printed by all these central banks has to go somewhere, and that somewhere tends to be equities. So they're enjoying that. At any rate, I will turn it over to Gil at this point. Yeah, just stay the course. If you're following the uptrend buy signals issued by the models, I think it's been now about a month altogether. They went to buy signal and sell signal respectively on MDM and VBM mid-March.
Yeah, I think actually it's been almost 6 weeks since the market direction model went to a buy signal. So I think that's actually the longest buy signal we've had on that for a while, which I think is good.
Yeah, longest the market's trended, I think, in quite a long time.
Yeah, I think this market, it requires a certain sort of approach, though, in my view. And what I've noticed, and I think I talked about this last week, is that every time the market pulls in, it starts to look ugly, and you'll see stocks coming down hard, leading stocks, or at least stocks that have been rallying pretty sharply off the lows, and that includes names that look like the NASDAQ, like Amazon or say a name like Workday, or you can use any number of these. Splunk's another one of these trying to come. They look similar to the NASDAQ in that they're coming up the right side. Whoops, I'm off track here. They're coming up the right side of these formations off of the February lows. And the way I've approached this market is whenever things start to look ugly, that's when you have to look at stepping in and buying shares. You have to be using this buy on weakness and either trim or sell into strength when the market rockets back to the upside. So on Tuesday, what was very interesting for those of you watching the market on an intraday basis Tuesday is that we started up on a big gap up and the market started coming in. The NASDAQ and the S&P both turned into the red. And this was early in the morning, I'm going to say within an hour or so of the beginning of the day. And the Dow was up like 5-6 points, and I'm thinking, I was short at that time because I had shorted the opening, and stocks are coming in hard, and I'm making some money. And then you see, as I'm going through my buy watch list, I see that a lot of the things I've liked on the long side, for example, Workday, whoops, I'm using an index chart here, I need to use this. Here we go. It's pulling into the 20-day line. You can see that here. I saw, Salesforce, another one, pulling into the 20-day line right there. Let me make this even bigger so you guys can really see what I'm talking about. You can see the pullback right into the 20-day line. That's the green line there. And then you can see names like, Amazon coming into the 10-day line and hardly budges. Facebook coming into the 50-day line, and that was on Tuesday. Yesterday there was some strange news out that their ad sales were declining, and so they sold the thing off hard, and then later in the day they came out and said that was a misprint, and they turned the thing back to the upside. It's like, okay. But that looks like big supporting action at the 50-day line. Actually, I was shorting it early in the day and then flipped to the long side. But in any case, my point is it found support at the 50-day line. Other names like Avago found support at the 20-day line. NVIDIA, which we've been looking at more recently, but it actually had a pocket pivot down here. It found support in the same way it did the last time it tested the 20-day line from a point just above the 20-day line. So it gets to a low of 35.14. The 20-day line is at 34.78, so that's about a little over 1% away from the moving average, which I think brings it into a viable position. Generally, what I do on the stocks I'm looking at on the long side, I'll set an alert about 1.5% above the 20-day line, and when that alert goes off, I know I'm getting close, and I can start looking at possibly taking a position on the pullback. I like to use a 20-day exponential. That's what this is here. And whenever, I think, same thing with you, right, Dr. K? Whenever we're referring to the 20-day moving average, we're referring to the 20-day exponential. So, but I don't like, another 4 syllables is difficult for me to get through. In any case, that's what you saw on Tuesday. Okay, so let's think about this for a second. What's going on? The market's looking like it's reversing, okay? And it's the third time, I believe, by that time it was the fourth, no, it was a third, hold on a second. Yeah, it was the third time. That was Tuesday morning. So if we look at this very closely on the NASDAQ, you can see what was going on. It's pretty interesting. You're just chopping back and forth along the 200-day line, and you're really at a point of reckoning, you could say, where if you can hold the 200-day line and move further above it, that's bullish, whereas if you break down, then we would come back and say, well, the 200-day line was resistance, and now we're going to roll back over again in a bigger bear market type move. But instead, we gap up to new highs. But on Tuesday, which is here, let's see, what's it, right? Today is Thursday. So right here, you can see it's starting to break the lows of this formation. So it's undercutting those lows and coming down on top of this formation. But you can see that on this day, you gapped down and went lower. The next day, you gapped up and you reversed back below the 200-day line. The next day, you gapped up again, traded a little higher, and then reversed back below the 200-day line. That looks very bearish. And I think in the old days, it probably would have been, but now we're in the age of QE and things act a little bit differently. It's as if they're trying to shake you out. So at this point, the indexes are moving to lower lows, the NASDAQ's moving to a lower low, everything's reversing, volume is up, it looks ugly. And at that very instant, I look at my stocks, and I'm looking at, some of my favorites actually. Workday coming into the 20-day line, Salesforce coming into the 20-day line. Vanted is another one I've liked coming into the 20-day line. That's Tuesday. See that? It's almost uncanny the way everything just kind of held the 20-day line and then turns around and rallies. And if you're getting scared out of your positions at that point, then you probably bottom too high. And I think the general approach, and the one that I abide by, is just to lay back and wait for my spot, because it comes. It may not come right away, but if you just lay back, you're going to look at that and you're going to see it happening, hopefully, if you maintain awareness of where all the stocks on your buy and also your short watch lists are at all times, because this market is more of a buy the weakness, sell the, buy the dip, sell the rip sort of market. And the other thing is, when you get a rip on the upside, I'll start looking at things on the short side. So I'll just give you an example. Today I've put out a short position on Nike, which is rallying up into the confluence of the 50-day, 200-day, and 20-day moving averages. So that's coming in a little bit. The retail group has been weak, so I'm looking at a thematic theme here. You got UA back up, Under Armour back up to the 200-day. Put that out there. Delta Airlines came out with earnings last night, and you had a gap up move, but if you're paying attention to the 620 chart here, you had a sell signal here. But usually what I'll look for is a MACD break here off the peak, and sure enough, you're up near the prior highs and it reverses off of there. Now yesterday we had JP Morgan, which I actually was looking at as a short previously. I'm not going to do anything in the earnings with this, obviously, and I didn't have a position yesterday when it gapped up. But in this case, if you go back and look at JP Morgan, yesterday, let's see, 413, correct? You gap up and you get this cross here, okay? So if you could try and test a short here, and then you're starting to think, okay, it's coming in, it's coming in. Now you turn, and it's going out again. So if you're short at that point, you're covering. Okay, so you test a short in here, you get out, maybe probably even, and you can flip and go long, and the thing just keeps going higher for the rest of the day. And then today we go a little higher, and it's up at 62.53. But you can see how you're looking at movements after an earnings report, and I think you get some tradable opportunities whenever you have a strong reaction to an earnings report. In some cases, it could become a viable gap up, which I think is what happened with JP Morgan, and it also triggered similar moves in Goldman Sachs, although not so much. I think Wells Fargo also had a little bit of a gap, but this one remains a weaker name, I think. WFC does. JPM is too big to fail, so that's why it keeps going higher, and you just can't make money shorting it. Even look at this. This I think is hilarious. It's like, look at this thing coming down, and then you get this massive gap down, huge volume. But what does that turn out to be? That turns out to be a big shakeout, and they gap it up the next day, and it continues higher from there, albeit in choppy fashion. But in any case, it's two different views of what can happen after an earnings report, and how you have to look at these. Because the volatility, I think, creates opportunities on a trading basis. And I'm more of an active trader in this market as opposed to trying to be an investor. I don't think, and I know people don't like to hear this, I don't think you're in a classic can slim, buy the breakout market and sit there and you're going to double your money. Like I said last week, I feel sorry for the poor slob who just read How to Make Money in Stocks and thinks they've discovered the holy grail. They're going to buy a breakout and make a ton of money, and they just end up getting beaten to death using a 6, 7, 8% stop loss over and over again. So I think we also see that that's the case in most breakouts. If you like this Maxilinear, okay, I made this point in our notes on the pocket pivots over the weekend, and that is names like Maxilinear, names like MACOM, blah, blah, whatever it's called, even SEMO, Silicon Motion. I like the name mainly. It sounds Hawaiian. So, but you can see this is pretty volatile, and you have to be selling into the strength, and then you can try and buy back on the pullback to the 20-day. But these are kind of junky names. Whereas you look at an NVIDIA, and that's been steady to the upside, not as volatile. And you look at Avago, has also been steadier to the upside. Now I'm seeing some other names coming around in the semi space. Qualcomm had a pocket pivot. Unfortunately, they announced earnings I think next Wednesday or Thursday. But you can see here's a pocket pivot on a pattern that's trying to come off the lows. So it's a bottom fishing pocket pivot. I also saw one in Ambarella, another semiconductor. And this was, now here's a great example of the ugly duckling at work. And in this case, what you have is a situation where the stock's looking pretty grim. It breaks right for the 50-day moving average. And notice this is occurring on Tuesday. Okay, so you've got this thing looking ugly, and the thing is, you have to step in and buy it right there if you like the stock. Okay, if you don't like it, you can just leave it alone. But look at how on Wednesday, yesterday, you get this big volume pocket pivot back up through the 20-day and 10-day moving averages. But I think this is kind of hilarious because of the way that it just gets everybody scared on the downside, and then the thing just turns around and takes off the next day. So anyways, I'm noticing that's on the short side. Some of these things are working a little bit, but the delta is turning up higher. Let's see. Let's look at this on a 620. And coming there, that looks kind of normal. You're getting a cross down here though on the MACD. You'll have to watch this one closely. In any case, looking at some other names, yesterday I noticed a bunch of names looking pretty strong, and among these you see Caterpillar, for example. Well, heck, give me a sec here. There's a big sort of pocket pivot move to higher highs. You have Baidu. There's another one, sort of a gap up pocket pivot to higher highs. Cummins Engine, which is related to Caterpillar, also a similar big move. So you have to wonder if in fact the global economy is so weak, why are we seeing these names rally? And you're also seeing steels are rallying, U.S. Steel, Steel Dynamics continuing to rally, and these are all coming up off of deep, deep lows. But these have had a very sharp rally off of the February lows. So this is what's leading the market, and you're wondering, what is this all about? Is this a move to hard assets? Is this a move into stocks as a precursor to a phase of economic growth? So it's somewhat confusing. But my general view is that it's just wild rotation. You have the oils moving as well. Look at a name I've been tracking, EOG, that's making higher highs. And it had, I'm not sure if this is a pocket pivot. Is that a pocket pivot? Let's see. G7 compared to here. No, just shy, but it's blasting through the 200-day moving average on higher volume, above average volume. So that's pushing hard. Watch Silica Holdings is setting up. You got some pocket pivots in the pattern. I think they come out with earnings in the next few days. I have to check that real quick here. Oops. $426. I think that's next week. So no, a week after next. So, anyways. Other oil names that have been pushing are this, remember this one, you guys? I talked about this a few weeks ago, Energy Recovery, and I told you all it's the new Plug Power. Remember Plug Power? It was like a $3 stock, ran up to 14. And this one's been pushing higher all the way. It's had pocket pivots all the way up. Most recently, pocket pivot off the 10-day line here, which was 8 days ago. And it's continuing higher. And these guys make pumps for both for fracking and also for desalination plants, water desalination or desalination, depending on how you want to, what term you want to use. But in any case, this thing just continued to go higher, and they actually make money. So you remember when I was first showing this one to you, Dr. It was around $6, way back.
Yeah, cheap. Right.
And it's gone higher, so it's kind of amusing. But you can get these stocks once in a while, especially if there's some sort of thematic driver. I think in this case, there are pumps being used in fracking. If you have resurgence in oil prices, then that's going to help on that end. And they also got a big deal with Halliburton. And on top of that, you have the desalination angle, which is not really a huge part of the business yet, but it may become a larger part of the business down the line. And certainly if desalination becomes a big factor They're talking about it less here in California because we got a fair amount of rain, and above Santa Barbara we got most of the rain, and they're doing pretty well. In Southern California, we're actually a desert, although people like to believe that somehow this is a tropical paradise. But the reality is LA is a desert, and was a desert until Mulholland and his cronies in the LA city government were able to wangle a deal to get water out of the Owens Valley, and I'm sure you guys are familiar with Mono Lake and whatnot. And they basically drained the valley, Owens Valley, and made the valley, the San Fernando Valley, of Valley Girl fame, turned it into an oasis, and scored big on their real estate holdings. In any case, water's always been an issue down here, but they're talking about it less, so that, in California where we had the drought, and even in the Midwest, I think 2 or 3 years ago they were whining about a drought, and yet we've seen some pretty nice flooding in places like, the usual suspects, Missouri, Texas, so the desalinization angle is probably diminished to some extent. So anyways, yeah, XON was another one. Somebody's pointing that one out. It had a pocket pivot yesterday, but see, again, look at that on Tuesday. That's when it's looking ugly, but it's an undercut and rally situation. It undercuts the lows, and I think in some cases, if you're a nimble trader, you can look for those types of setups, looking for undercuts within uptrends. So this is an uptrend. You have an area here, a base, and the lows of this range, it undercuts, and that sets up an undercut and rally. And that, in this market, is a very valid setup to play, and it's Wyckofffian at its core. Because that's a type of a springboard that Wyckoff would talk about. Neil tells you to buy breakouts so that you're not making any money, you're not going anywhere, but here you get a nice move back to the 200-day, so that's been resistance so far. I'm not so sure I'd want to be jumping all over it, but it's interesting that it came off of this position, and it shows you that this is the type of thing you need to be looking for. If you're looking for breakouts and thinking you're going to buy breakouts and make tons of money, I think you're sadly mistaken, unfortunately. I'd love to see this market environment change, where we have a better trending environment. You can buy breakouts and see them go up, 2, 3, 4 times like we used to in the old days. But that just doesn't seem to happen anymore. And you either live with it and adapt to it, or you just kind of flounder and just get more frustrated. So some other ones that I saw yesterday, Alibaba had a pocket pivot yesterday. You can see that, but see, that's coming out similar position. So that looks okay, but I buy it only off the 10-day line. Ultimately, I'd like to see a pullback to the 20-day line, because that has been support all the way up. You see a pullback here, you see pullbacks in here. Some other things, like look at this EBIX. If you're trying to play this, I'm sure you're having a load of fun with this. But again, you get the move here, pocket pivot here, moves higher, and it's chopping back and forth. I'm not sure, where do we put this one on, Dr. K? Was it in here or down further lower in February? Was it late February or sometime in March? I forget.
I can check real fast. I'm not real. It's been a little while. EBIX. Yeah, let's see. This one was the. Looks like we mentioned it on the 28th and the 9th. Well, it's we mentioned a few times.
Yeah.
The 17th of March
Was the last one. So back here when it had a pocket pivot, but it doesn't go anywhere. It runs up to these highs, the ties of the range, and comes in. So it's pretty obvious you've got sellers every time it runs up there. But notice how it undercuts a 50-day line on Tuesday, of course, and holds a 50 line and turns. The next day you get this huge move to the upside on big volume. And that looks very powerful, but you can't buy into that. You had to be buying it on Tuesday. So another situation where you see this sort of movement. And one I've been watching, Trimble Navigation, has done pretty well. Here we go. There's a nice base breakout, but it's been hanging out in here, and you had to be buying it along the 20-day line, and that's worked out pretty well for anybody who's followed that one. Another one is this Universal Display Corporation. It's been viable along the 20-day line, and here you have a pocket pivot yesterday, but notice how on Tuesday it hit the 20-day line, and bonk, pops back to the upside. So that's nice move, but are you going to buy it here? No. So now if you didn't step in a lot of these names either Tuesday or yesterday at the very latest, I think you're sort of behind the curve here, and you don't want to be chasing anything on the upside. So you really just got to keep a list of what you like that you think is viable, and you buy it on a pullback. And I think what's going to happen is you're going to be in a position where the market's not going to look so good. You're going to have a pretty sharp pullback in the indexes, and it's going to it's going to cause you to freeze up, and you're not going to want to buy these names. Yet, that's precisely when you need to be buying them. So I think that the key here is to keep in mind that, number one, if you have a name like this and you like it, okay, and you see it pulling into the 20 to 9, well, you know you're getting close to a point where you can buy it, and you just scoot and get out of the way if the thing keeps breaking down. So you're much better off, buying it here and getting stopped out 1% or 2 lower than you are buying it up here and getting stopped out 4 or 5% lower. So, I think that's really the only way that you can operate in this market, in the safest way. Because I still think, and chime in if you have anything to say about this, Dr. K, I think we're still in a dangerous environment where you can wake up one morning and there's some random news and some sort of meltdown occurring out there in the financial world, and your stocks are breaking hard, and we get some sort of a crash move to the downside. I still think you're in danger of that. So I think you have to be active in trying to work yourself into a position where you have a profit cushion that is going to help you deal with something like that should it occur. My approach has been, early in the year, I was taking smaller positions, building up small cushion, then as it got a little bigger positions, and now I've got a pretty decent cushion here, 15-20%, where I'm a little more willing. I can sit with things overnight if I want to, or I can take some bigger positions and see if I can catch some of the pullbacks. In other words, I'm able to take some of these shots when things don't look so hot, but I'm operating on the basis of the ugly duckling theory, which is that when things look their ugliest in this market, that's the time to be stepping in. But it helps if you have a specific method, or method to your madness, say, where you're able to buy on a pullback as close to a support level as possible, so that you're able to keep a very tight stop. 1 to 2% losses are very tolerable. I think if you're buying breakouts and getting hit with 6, 7, 8% losses over and over and over again, then you're not going to be having such a good time. So, anyways, somebody's saying the 620. Oh, go ahead, Dr. K.
Yeah, I was going to say, just to address that in regards to the VIX volatility model, it's the reason why that on sell signals it buys the XIV. Now, if there were a 2x version of that, it would not do a 2x, simply because, on meltdowns, you can have a gap down event overnight that is, it doesn't, generally the market has always given warnings ahead of time. I think that's in every case, but there's always a time for a first where the market gives no warning and we have a serious gap down on our hands overnight. And I think we're getting closer and closer to those probabilities just because it's the direction the world's been heading over the last few years, and that acceleration seems to be quickening in terms of surprise negative news events. So, in other words, if we have a meltdown, the model's more than happy to be sitting, say, on a 2x ETF such as UVXY, because in that event, the UVXY would just spike a whole lot higher. In fact, it did do that when the market had that real trying situation last August. And in the testing, too bad it wasn't trading as with all the rules it is right now, but overnight it was up 108%. Just sitting in UVXY, and naturally the model would, at the open, just sell, as a rule, profit taking, and that would have been a no-brainer to just take that profit at that level. So markets can melt down, and the model's more than happy to sit on a 2x UVXY. But on the other hand, if you were sitting in XIV, and so let's say the model got it wrong, XIV is a 1x, so overnight yeah, it's going to get hit very hard, but it won't be a 2x catastrophe. So if there were a 2x version of XIV, the model still wouldn't trade on that basis, simply because there's too much risk of a gap down that can occur overnight. So yeah, I wanted to make that clear, because some people wanted to know, if there would be a 2x at some point. And my advice would be, you really don't want to be trading the 2x just in that unlikely event. It's very unlikely, but still. And this also goes to the whole thing about how if you look at the VXX or the UVXY, they tend to trend lower and lower over a long period of time. But the problem there is that overnight event where these things can spike over 100% in a day. And if you're short these positions, you get killed. You get wiped out just overnight. So, I know it looks tempting on the graph on VXX to say, oh, I'm going to just blindly short the thing and do well. And believe me, I've tested this backwards and forwards because I thought it looked too good to be true. And it is too good to be true, because while you might do well 90% of the time, you're not going to know that 5% or that 2% eventuality where you're going to get creamed, and all those profits you made could potentially get wiped out, or at least 80% of it could get wiped out, and that can be very damaging to someone's investment psychology. So it's just better to keep that kind of risk element out of the model altogether.
Yeah, not to mention your account value. Anyways, yeah, I noticed some people emailing us thinking they see a bottom in this thing, but so far we're going to lower lows. Now, does that mean we're getting a bit complacent here, and that the market is perhaps setting up for some sort of a more concerted pullback? And one thing that I've been bothered by a little bit, let me see if I can pull this up. You guys might remember I brought this up last week. And that is this is the percentage of stocks above their 50-day moving average is now reaching an extreme peak. So if we look at this over the last, say, 3.5 years, you can see you're way beyond where you've been each time you've had a peak. So this is making me think that this rally could come to a halt here at any point, and I think you have to be ready for that. And that's why I'm talking about this idea of limiting your risk, even when things look as bullishly as they do. And you have to admit that the market does look bullish here, the way the indexes have broken out to higher highs. But we also know that over the last year or so, in the past, whenever that has happened, and like the Nasdaq was breaking out to new highs, all-time highs, and everybody's making a big deal of that in late July of last year, and that's when the market topped and blew apart. So I think you could see things reverse off the peak. So I think you just have to be playing an active game, and that's why I'm more, like I said, more of a trader than an investor. And you can see that this is definitely showing you movement to extreme highs. In fact, let's make it, hopefully you guys can see this okay. Let's make this even longer. Let's just look at it over the last 6 years, say. And you can see, if we look over the last 6 years, you're definitely at the highest high it's been at since 2010, since the end of 2009. So let's just take it back one more year. That way we'll pull in the QE era. You can see if we go all the way back to 2009, it's exceeding all those highs. So, and we also look at I want to look at the 150. This is something that we used to look at O'Neill. It's getting above 50%. So this looks less bad, but this looks, you're still in a dangerous area. So anyways, just thought I'd mention that. Somebody says the 620 chart is really helpful in an undercut and rally. Often when they don't work out, I can get out at a break even or a very small loss. And yeah, I find that to be the case. So for example, in a situation where let's pick XOM. Let's go to that day where this day would have been the 12th. So if we go back on the 12th, you can see here's where it breaks down, but early in the day, and so you're making this low at 32.12, 20, so that's here, right above the 32 level. I guess it kisses the 32 level here, and then turns back to the upside. It takes it a little while, and it never really gets a buy signal except for here, but so you could be trying to buy it here. So this would not have worked as cleanly as you would like, but you could have got in yesterday on a buy signal here, and the thing would have charged back to the upside. So it looks like the market's getting some momentum to the upside, so looking good so far. But again, you still don't want to be chasing into the strength. You want to be buying things on pullbacks, and that's what you're looking for. So that's where you want to stay, and you don't want to get carried away with chasing things on the upside. And it's nice if you're long some things. It's nice to see them move higher. I'm noticing like things I'm short aren't really moving against me at all. Really, Nike is hanging here a lot along the 60 level, so that's just sitting there. Under Armour's come off from the 200-day, and that's just sitting there. GoDaddy's moving a little bit here. This one is one that I've looked at as a late-stage failed base. You can see here you have a cup with handle, and it's very V-shaped. So you might say it's a little bit flawed, and they come out with a secondary, knocks the thing down, and it rallies back up here, and then breaks down with the market earlier in the week. So we know if the market gets weak, this thing gets a lot weaker. And now you're rallying on very light volume back up into the underside of this base here, and it just passed the 20-day line. So it may find resistance along the 32 level, so I'll start putting it out in here and just have it in my back pocket in case I need something to short. I'm looking for something to short. So meanwhile, you can see that you still have some leaders that are getting whacked. Look at Palo Alto Networks. That's just getting destroyed. And I think that's taken cyber with it. So there are short selling opportunities out there if you can find them. And I think it's just a matter of playing them when you see them. And if you want to have one or two short positions, depending on what you're long, I think that can make sense, and I'll do that. So it offsets a little bit. Also, if I'm shorting some things on a day like Tuesday, and I can see that there are things on the long side coming into areas of support where I might want to be buying, then I can step in knowing that if things do come off some more, I'll be hedged to some extent with my shorts. So, playing it both ways and trying to keep yourself safe, because like I said, we looked at that percentage of NASDAQ stocks above their 50-day moving average, and you are at an extreme peak in that. So, just when everybody gets real bullish and everything looks very positive, I think you have to be cognizant of the dangers and operate accordingly. And again, we just get back to the same concept of looking to buy on weakness and sell on strength. So anyways, some other names. I'm watching Square come in. This stock's been, we talked about it down here, and this acted pretty well. It continues to follow the 10-day line. It's pulling into the 10-day line. Ultimately, I would like it at the 20-day line. So earnings come out on the 5th of May. Look at Tesla. Everybody loves to hate the stock, but it just keeps going higher. It had a couple of pocket pivots right at the 200-day line here. Continued higher, and at that point, it's getting about 10% higher. So if you were trading it off the 200-day line, you get this move, then I think you're able to take a profit and then look at buying it back on Tuesday right at the 10-day line. Imagine that. And that's pretty much how this market tends to roll, So, okay, any other questions here? You guys are pretty quiet today. Everybody's confused, perhaps. Here's, did we put this on? We didn't put this on as a viable gap up, and that's why it's working. So it's continuing to go higher. This is acting pretty well. Look at Global Payments, another one that has continued to go higher after a gap up move. So some of these gap up moves are working, and not too shabbily, I might add. So AYI is working. Of course, a cousin to AYI's CRE, and that's in a bearish flag here, and this might be something I look at as a short up near the 25 level. So it's in a bearish flag. It looks like it wants to break lower. Let's see, what else? Skechers is another one I was looking at. That's finding some resistance at the 20-day line. That's been rallying, but that's a weak name. And the retail names have been probably the weakest part of the market. And so I think, in general, that is an area I'm looking at shorting today. I'm actually short UA and Nike, and they're trading below where I shorted them, so they're hanging in there. So this DAL though is now starting to push just a pinch. This might hold up. The airlines in general though have been pretty strong, but the big ones like UAL, DAL, and AAL, American United and Delta, and this one is Delta obviously. The Southwest Airlines is looking a little grim here, but notice how it comes off the 20-day and it's breaking out to new highs. I thought Elke last week was a nice little short off the 20-day line, but it has found its feet and now is moving to higher highs. So if you're trying to short it along the 20-day line, as I have been, and I've been picking it off every day, but it was able to get above the line yesterday, and I wasn't really playing it at that point. I think I did nothing but make money on this thing, but you know, a buck here, a buck there, and now it's pushed higher. So all these airlines are trying to come back. So I don't know if they're going to make it. Some of them look shortable too. The DAL still looks kind of shortable to me. JetBlue coming up. This is one of the weaker ones. And then you have Save, which is also trying to break out of this little range, but it's just coming to the top of the range. And this one's been one of the weakest names in the group. Hasn't rallied that much off of its prior lows. That's one area I'm looking at as potential shorts, but you're going to need to see some confirmation. Let's see, Facebook, we looked at that. Panera Bread, this one's interesting. This one hit the 50-day line and bounced off, and it's just kind of hanging in a base, so not much going on. Shows some supporting action along here, along the 50-day line, and just kind of chopping back and forth. So I'm not sure. This is in retail too. It's a restaurant, so I'm not so sure I trust this one. I noticed Sonic has continued to act reasonably well after having a viable gap up. I think Starbucks, however, got whacked the other day on a gap down to the 200-day line. That was on Tuesday, and that was a buy opportunity for anybody who saw that. And I know some people were wanting to short it, but it just barely undercut this low. I think this low is 58.28, and it came in at no, I take that back. It did undercut this low. It actually just bounced off the 200-day line. So HA is reporting earnings. How to handle? Well, how else are you supposed to handle it? You decide, are you going to hold through earnings or not? Are you going to take partial profits and hold through earnings? Or are you going to sell the whole thing and avoid the whole situation? So, you know, okay, I have to say that I think that question, you know, you have a stock that's going to earnings, how to handle. That's kind of a dumb question, because you have three choices really. Hold the whole position, take partial profits, and be ready to sit through whatever happens, or sell the whole thing and bag your profit and then wait to see what happens after earnings. What else is there to do? Is there some magic choice that you can make? No. All you can do is figure out what you're willing to lose if you're wrong and the thing gets whacked after earnings. My guess is probably won't, but you know, that's basically what you're doing. You know, a lot of people think there's some magic answer to holding or not holding through earnings, and there really isn't. You know, I can't predict what stocks are going to do, and there are a lot of times where I think a stock is likely to break down after earnings or go higher. For example, what do you guys think Facebook is going to do when they come out with earnings in a couple of weeks? Are they going to beat and rally to the upside, or are they going to get smoked? You know, do you know? Does anybody know? Do you have an opinion on that one, Dr. K?
Yeah, doesn't really matter.
No, it doesn't. If I bought the stock at 100 and I have a 10% cushion, then maybe I can think about sitting. But if you just bought the stock off the 50-day and you got a 3 or 4% cushion, maybe I just want to put that in the bank and hang out and be happy. You know, so that's really what it boils down to. What are you willing to lose? Or as Clint Eastwood would say, do you feel lucky, punk? It basically boils down to that. You know, spin the roulette wheel and see what comes up. So, anyways, you could buy puts, I guess, you know, but that doesn't always necessarily help either. So, like I said, you have three choices. Hold the whole position and spin the wheel and hope that you come up with a big number on the earnings roulette wheel. Sell half and then see what happens and lock in at least partial profits so you don't end up coming away with no gains from the stock. Or dump the whole thing and then just forget about it. You know, if you think about it, look at this thing. This is where I would be buying it, down here, okay? You got a pocket pivot here. That's where you should be buying it, right there. Okay, then it breaks out. Maybe you could buy a little on the breakout, although I don't trust breakouts. But you got some pocket pivots along the way you could be adding. And now, if you consider that if you were smart enough to buy on this pocket pivot, which is where I prefer to buy anything, it's lower in the base, then what do you got? You got yourself a nice, 30% profit. That's the sort of profit I just put in the bank and forget about it. Because, is it going to gap higher? I don't know. Spin the wheel. Spin the wheel, baby. Anyways, all right. Any other exciting stocks here? Let me look through my magical list. How about gold? Gold is in a range here, and it's just going sideways. I heard, I remember this guy, Dolmer is his name. He's based here in LA. He used to call me when I worked at O'Neill. And I saw him on Asian CNBC. I like watching the Asian CNBC or CNBC Asia. Much different than the hypey sort of version you get here in the U.S. But he was on there. Bert Dolmer, that's the guy's name. And he was saying he believes gold is going to be one of the top 2 investments for 2016. And okay, I'm all for it, I guess, if it wants to be. I still own a fair amount of gold from 2000. And all it's doing, though, is moving in a consolidation. So perhaps it is setting up for a breakout. I think, though, if you're into buying it, you have to look at the lows of the range. And, 114 to 115 in here probably is where it becomes viable. Otherwise, I don't see the point in trying to buy into strength. I like the big shakeout here. Not quite a pocket pivot, but this is a nice big shakeout 6 days ago. And flopping around now and pulling back in. But I think if you're looking to buy gold, then you got to be buying on the lows. Silver is actually, notice how silver's starting to outperform. And they continue to sell these silver eagles in the U.S. They're selling them like mad. And they keep running out, and they have to mint some more, and every time they come out and they all get sold. I think they've been selling record numbers of these things. But you're seeing silver breaking out. So that would seem to lead you to believe that gold is going to follow suit. So, something to think about if you want to go long gold. But the thing is to look for a point of weakness, or look for weakness and a point of support, rather, I should say. So 116 on the GLD, if that's what you're looking at. And then you can set your stop wherever you want down in here. So, but that's a possibility. So, someone's asking a question. One question: I've always hesitated when evaluating bases that form under the 200-day moving average. Do you use any different rules in judging these bases? No, I would just forget about evaluating bases under the 200-day moving average, because that's kind of an old O'Neill thing. It's a weak stock because it's under the 200. In this market where you see the things that are having the biggest moves are the stocks coming off their lows, and generally from a position below their 200-day moving average, you want to buy them. So that's why I think roundabout and bottom fishing pocket pivots and even gap up type moves can be bought. And I wouldn't pay attention to any of that. I think that's old canned slim stuff that, for now at least, I think is out the window. It's pointless and doesn't really work. I just look at the pocket pivots and the viable gap ups and the roundabout and bottom fishing pocket pivots coming off the lows. Some examples to look at. CRM coming off. Here's a gap up move. That's a nice gap. I just buy that. It's under the 200-day. So what? And it goes higher. Workday was another one. I bought that. I was actually trying to short it here. I think I've talked about this before. I'm trying to short it here, and I could feel that there was no let up in the bid. It would start to come in, and then boom, here comes the bid, and they're pushing it back up. So I covered the short and went long. And the next 3-4 days, I got a really nice 10% move to the upside. Sold into that, and then come back into it and start playing it again here. And then buy the pullback on Tuesday, and boom, we're trying to go higher, although you may run into resistance and pull back. But I'm just looking for the setups. And my suggestion would be to read Wyckoff. There's actually a new book that I'm reading right now, and I'm trying to remember what it was called. Give me 1 second. I gotta pull this up on my iPad. I also recently got a Samsung pad. which I'm testing out. It's called Price Action Breakdown, Exclusive Price Action Trading Approach to Financial Markets. So again, Price Action Breakdown, : Exclusive Price Action Trading Approach to the Financial Markets. And that is by, let's see, I can't even read the guy's name. Laurentiu Damir. The last name is spelled D as in dog, A-M as in Mary, I-R. First name is Laurentiu, which is like L-A-U-R-E-N-T-I-U. But anyways, I would read this book, and I would read the new Wyckoff book. Well, it's not that new, but Trade's About to Happen, and start to try and understand the idea or the concept of reading price volume action and paying less attention to all these old CAN-SLIM rules, which I think are just totally outmoded and don't work anymore. Okay, not as long as we're in this rotational market where the biggest movers are things coming off the lows, like the steels. And where could this have been bought? Well, notice you have this nice low base in here off the lows, and you're getting a pocket pivot in here off the 10-day line, and kaboom, there it goes. So that would be a setup I would be looking for. And I'll tell you what helps me a lot and why I use it basically to print money these days, because I'm working on my 4th straight year up year in a row, and in the past I've never had more than 2 up years in a row. So things to look at. Once they start to get, I look at these gray, I don't know if you guys can see them, hopefully you can, but they're these gray bingo bars, as Ian Woodward calls them, but they're basically oversold bars. And when you start seeing a lot of these clustering together, so at least 3 clusters, and here you have 1, 2, you have 3, basically 3 clusters there, and the thing bottoms out and it starts to turn. And so you start seeing the force starting to change colors, and you can see this right about here. You see that? I mean, you had a little bit of color change here, but now you got this top Bongo Weekly line also starting to confirm blue, and the whole thing's going code blue, and you're seeing these upside kahunas, these dark blue bars right in here. I don't know if hopefully you guys can see those in here. And it's able to turn off the lows and go, and that's what I'll be looking for. So, when I'm looking at something like look at this. You have a whole bunch of, just a huge cluster of oversold bars. As soon as you get this breakdown and this bounce in the gap, now I'm turning and going long. Instead of trying to sit there and wait for it to break out or saying, oh, it's below the 200-day line. To me, that's hack stuff now. It's CAN-SLIM hack stuff. I hate to say it, but it is. And but a lot of people have been brainwashed into believing that that's the only way to invest. And I can tell you, hands down, after working at O'Neill, where I was head of the department, and Dr. K knows this too because he used to help me quite a bit. He's a big factor there in terms of helping advise the institutional investors. But most of the time we found ourselves trying to spin our approach to the market in a manner that would be useful to methods that aren't necessarily buying breakouts. Someone's got to create the bottom of a base. Someone creates the bottom of a chart pattern. And those are the institutions. And I'm going to tell you, 99% of the institutions we dealt with, there's probably a handful, maybe not 99, 95%. We had 600 and something clients. And I'm going to say 20 or 30 of them were CAN-SLIM types. And those are mostly very rapid trading hedge funds or nimble hedge funds. I'm seeing GoDaddy start to reverse. Remember that, Dr. K? I mean, how many of those guys used CAN-SLIM? Almost none, Yeah, I mean, they would laugh if you showed them a breakout. They'd say, oh, those are my footprints. Go ahead.
They're running too much money. I mean, there's not, CAN-SLIM's a retail product. So if you have a small account, then it can work very well, especially in those years. But when you're running a fund, it's standard that you're the ones making the basis and making the patterns.
Right, but I saw a lot of guys using other methods that would work, and hedge fund guys buying off the lows, buying on bases rounding out. I knew, like Ron Ogner used to love. He was doing running his strong funds. He used to love buying stocks as they were shaping the lows of the bases, and he would watch the relative strength line and look for it to be making a higher high, not necessarily a new high, but turning off the lows and making a higher high as a stock was basing along the lows. So, for example, if we're looking at the X this here, he would be looking for something like that, and then the relative strength line starting to turn, and then he would come after it. For me, I use the pocket pivots off the lows. You can see them; they're there, and you can take a shot as long as you can control your risk. And in my view, there's no more or less risk these days, given the way the market works and its rotational in nature. There's no less risk buying this type of setup than there is in buying a breakout, and I might argue that there's more risk in buying a breakout. So anyways, hopefully that's helpful. But I definitely think you have to change your way of thinking. And that said, I also think you have to remain flexible enough that you recognize when the market starts trending again, and we're going back to the good old days, which I don't know when that's going to be. Is that going to be before or after the collapse, Dr. K?
I think we need to see the ushering of a whole new era.
There you go.
Anyway, with each passing day, I tend to believe that more and more, that everything has to fall apart before it can fall into place again.
Yeah, I was having lunch with Fred Richards. Some of you might know Fred. Fred actually is a childhood friend of Bill O'Neill's, and I never even heard about him from Bill the whole time I worked there. And then I finally, he contacted me through another person, wanted to have lunch in 2007 or 2008. And we had lunch, and we become fast friends since. I had brunch with him on Sunday, and we were talking about this, how everybody, you see all these presidential candidates talking about how we need to take our country back, we need to fix this, and the system's rigged, and blah, blah, blah. And I think in some sense they're all a little bit right. But his point is, there's the only way you're ever going to fix it, it's going to collapse. And that's the only way it's ever going to be fixed, because otherwise you're looking at a system, a bureaucracy that's so entrenched that there's just no way it's going to come loose unless there's a major event that causes it to collapse. And I said, oh, that's going to be like the French Revolution. They're going to be beheading government officials. And he just laughs and nods his head. And maybe that's where we're headed. So,
well, it's for the first time, and as everyone, well, a lot of people know, I'm a market historian, and I like to go back hundreds of years. But there's Martin Armstrong, who's gone back thousands of years, so he puts me to shame. And I got to tell you, he's the only one I know that has gone back that far and has such an academic and analytical knowledge of what happened in these various cycles throughout human history. And I love reading his blogs. They're very educational for me. And then I can also, when he says certain things, it seems so unbelievable. Of course, the internet's the internet, so I can go and confirm what he's claiming for myself. And I got to say, he's generally right on the mark. So, this is the first time I can remember where a guy like him and a guy like Ed Seykota and a guy like Fred Richards, and then there's a number of other people I've met in my travels, and some of these people are pretty extraordinary, I got to say, just in terms of where they sit, in terms of power, in terms of who they know. And they're basically all on the same page for the first time I've witnessed. And they're all saying, this is the collapse is inevitable, day of reckoning is coming, etc. And these are not crackpots. These are not, hippies that are, the guys that used to say in the 1960s or in the 1980s, you got to buy gold because, all society's going to just collapse. And I think they were a bit premature, but this time it looks very real. And of course, backing up that is all the mind-numbing, shocking headlines that keep coming out. That seem to indicate that things are getting worse and worse, by the day. So, I like Ed Seykota's book because it's not a sky is falling kind of mentality. He's saying, yeah, the sky will fall, but that's what needs to happen for a new era to be ushered in. And as he points out in his book, based on history, the collapse comes pretty quickly. And he wrote this book about 2 years ago, and it was Gallipoli into 39th day. So the 39th day means that one more day, all the duckweed in the pond doubles once again and suffocates all life in the pond ecosystem. So he equates, the analogy there is that humanity is in that 39th day. So we're at the tipping point of the end. And Martin Armstrong backs that up with saying, well, late last year was the turning point. Next year's going to be the year of political hell. And his IP, actually is very specific about the dates. And he's been running his IP, I think, since the late 70s, which is quite an admirable track record there. So it's interesting that these very successful people have kind of all coincided in terms of their timelines. Um, so yeah, I think it's a fascinating time to be around. And like I said at the beginning of this year, on January 2nd, I wrote that this year is probably going to be a year of elevated volatility, which is good for the BVM model. And that amplified volatility may continue, it may be persistent. Like we saw from 2000 to 2002, obviously the volatility was historically at its highest average over those 3 years. I really wish the model had been active at that point. Those were some of its best years. So maybe we'll see sort of somewhat of a repeat of some sort of bearish trend emerge in the markets as a result of what's going on. And that would be actually quite nice, because then we could see some serious triple-digit returns, even in a market where people are losing their shirts.
What's the name of this guy's book? Mort Armstrong's book, Dr. K? Someone's asking.
Martin Armstrong never wrote a book. He's got a website called ArmstrongEconomics.com. And they also did a documentary on his ordeal with the U.S. government that was suppressed, but it's been widely distributed in other parts of the world. And unfortunately, I gotta say that's in my travels. There's a lot of stuff out there outside of the U.S. that exists as standard, but within the U.S. It's often suppressed. But then that's no different than, of course, what goes on in China. Different governments will do their thing to keep certain documents or documentaries out of the hands of the public. But the internet's great. You can download his documentary because it's been pirated all over the place. So it's called The Forecaster, and it's readily available all over the place. Even I think on some of the Chinese websites, it's been pirated. And there's apparently he made an announcement that there's a fairly well-known or very well-known Hollywood producer who got wind of his ordeal and now wants to actually make a proper film out of it. So they're in discussion. So that's all good. These are at least and all this negative news that seems to hit the world on a daily basis. It's good to hear that at least there's some good news out there. That's some truthful see the sunlight.
Anyway.
But yeah, check out his website.
Okay, and Sakota's book, we've talked about it a million times, Govopoly in the 39th Day. So, anyways, that's all we've got. I think, like I said, you're in a dangerous position, but on the other hand, the action is bullish. So the only way to operate is be opportunistic, look for pullbacks to buy into, and that allows you to limit your risk. And I think that's the one approach until things break down and we start to flip back to the short side. In the meantime, I'm also willing to look at short sale candidates and have a position short in something. And I've actually found that a few of them will work. Palo Alto Networks blew apart, and that's worked pretty well. I've actually been making money shorting GoDaddy every time on this, when it rallied here, then you have this break, now you got another rally, and it's starting to reverse. You can see that, down 21 cents. I still think Delta Airlines probably needs to be watched. These are laggard airlines, and I think this kind of move into the highs of the range, this is what you look like. Whoops. Notice that the whole time other airlines have been going nuts, this thing hasn't. So it's in a sort of a later stage position, so it could fail. And I think you want to keep an eye on stuff like that. Nike is another one. Skechers is another one. Let's see, Apple, real quickly. This had a pocket pivot. So there's another one showing strength yesterday. So I'm not so sure. Even Netflix rallying, but these come out with earnings in the next few days. I wouldn't want to mess with them. But I think that's basically the approach. I stand by my method of buying into weakness and selling at least partially into strength. And especially when you get a huge move in a stock like you do with Silicon Motion, for example, if you bought, we put this out as a pocket pivot here at 34 bucks, and then it rallied to 40, so you get a nice 20% plus move there, I think, maybe 17, 18. And you sell into that when it looks powerful, and then you could buy back here. At least if you're doing this, when things pull in, you at least have enough cash in your pocket that you can keep your senses and be able to evaluate things so that you can take advantage of what are ostensibly trading opportunities, okay? So, and that's just a practical way to approach these markets. And I would suggest reading the books that I mentioned. So I do think that you can, in this first book I was mentioning, using price action analysis, it basically postulates that you don't need any indicators and you don't need any volume. All you need is price action. And that's that. So think about that. Keep things simple. So I get rid of these lines down at the bottom and I just look at that. So and that's the way I trade Forex, actually. I don't look at any volume because you really can't tell what the volume is because it's an international market. In any case, we've been babbling. Someone says Armstrong is a nutcase who spent 7 years in prison. Probably.
Yeah, I love when people bring that up because first,
we got that.
Diligence and no, I love it because it's understandable. First of all, I mean, I approached the guy with that same belief because of what I've read in the press and etc. But when you dig deeper, you'll see for yourself. Actually, it's very illuminating how the U.S. government works on some levels, and that's why they made the documentary in the first place, and that's why the big Hollywood producer wants to actually bring this really into the limelight. But he's not the only one. There's quite a few people who've been thrown under the bus, and because at the time he was going to whistleblow on Goldman Sachs and a number of other investment banks. He possessed some knowledge, and they didn't want that happening. But again, this is sort of a broken record in terms of how deep the rabbit hole goes. So I encourage everyone to do their due diligence, Google for all these documents, and just kind of sift through it and digest it and come to your own conclusions. There's a lot of information out there, and there's a lot of misinformation. So it takes some doing. It's not something you can maybe just conclude with a few hours of investigation. It might take a longer period than that. But I think everyone needs to go do the due diligence. It's like creating your own trading strategy. No one can do it for you. You have to do it yourself, and then come up with something that you're comfortable with, or something that works, for your belief system. But yeah, the guys I think quite tremendous in terms of the historicals. You can see for yourself, how many predictions he's made and which ones are quite on the head. So anyway.
Okay, we've gone over our time. I'm going to get back to trading. I smell money here. Look at this GoDaddy starting to come down. Even the DAL might be reversing here, although we did get a 620 buy signal here, but it may not hold. Anyways, you guys, thanks for showing up. Go check it out, Armstrong. Go check out Ed Sakota. Go check out the book I talked about. Play it safe and keep your head and remain opportunistic, shrewdly opportunistic, I might add. Anyways, that's all we got, you guys. Thanks for showing up. Have a great weekend. We'll catch you next week. Take care.
So long.